Economists are expecting a further slowdown in South Africa's inflation. That's the anticipation ahead of the latest consumer price inflation figures for the month of May to be released by StatsSA later today. The previous reading saw CPI drop to 6.8% in April. That's from the 7.1% recorded in the previous month. While further easing is expected, inflation is still forecast to remain above the Reserve Bank's 3 to 6% target range. This still opens the door to a continuation in the central bank's interest rate hiking cycle. Economist Chifipa Mhango joins us now for this discussion. Thank you so much for your time, Chifipa. Let's start here. What's the expectation this time around in CPI?
Well, morning to your listeners and morning to Tommy yourself there. Well, I think we're expecting a moderation in terms of inflation with the current figure at the range of about 6.5% is what the actual figure we're looking at in terms of the CPI data for today.
Now, that would be a good development, seeing that inflation is dropping slightly. But what are the major concerns, particularly where food inflation is concerned?
Well, I think I was just looking at the data from across the globe in terms of what's happening. Globally, we are also seeing moderation in terms of inflation. I think mostly attributed to the easing in terms of food prices as well as energy prices. So we're expecting a similar kind of trend on the domestic front.
Moderation, as you indicate, is what the market is expecting with this reading. What then would it say to the South African Reserve Bank? We've seen the ECB hike rates, but the U.S. Federal Reserve, they've decided to pause.
Well, I think that's what I was seeing. No matter how the Reserve Bank has been doing is more or less like looking at what's happening globally in terms of the movement of the monetary policy environment. So far, what we have seen that in the major economies such as the USA, we've observed that the last meeting, the interest rates or lending rates remain unchanged. Recently, just this week, we've observed that in China, they have slashed the interest rates, trying to boost growth. Much as there have been movement upwards in terms of the ECB, which is the European Central Bank, it's more driven by the fact that inflation rate there remains slightly higher above the target range of 2%. So domestically, I think if we start seeing movements in interest rates whereby there could be a movement down to about 6.5%, obviously it's getting closer to the upper range of the target range of the Reserve Bank, which is 6%. So it would just be above that upper range by 0.5%. So realistically, I think going forward from the monetary policy environment, we might see an approach from the Reserve Bank whereby they leave the rates unchanged, more or less taking the lead from what has been happening in the U.S. market.
Now, a further easing in CPI would mean that there have been several months of a consecutive drop when it comes to inflation, from 7.1% earlier to 6.8%, and now the anticipation is at least of around 6.5%. Is this sustainable in terms of a near-term outlook, in that this is the marginal decrease that South Africa as an economy could be expecting going forward?
Well, I think it could be sustainable depending on how the situation prevails. I think the major concern would be around the currency movements. We've seen a little bit of destabilization of the currency recently. But also there's still destabilization of the geopolitical aspects, especially with the war in Ukraine, which still got an impact in terms of food prices. But I think we've observed some stabilization, which tells you that from the point of view of monetary policy, globally as well as domestically, something positive is actually happening at that front. So there is room for this to be sustained on the longer term.
Lastly, the impact of load shedding on the South African economy, does it have any bearing on CPI?
Well, it does. I think that has got a major impact in terms of food prices. What you have observed, for instance, is how the retail environment is actually taking across in terms of the cost of trying to generate their own power. So those costs have actually been passed on to the consumers. So I think the easing of the load shedding currently might have a positive impact in terms of having the retail shops relying on Eskom generation, which might reduce the cost burden which they have been occurring on a monthly basis in terms of keeping their shops open with the generation of their own power by buying their own diesel. So there is a positive impact in terms of the easing of load shedding domestically.
Thank you so much for your input. Chifipa Mhango is a chief economist at the Dawn Consulting Group, talking to us in that preview ahead of the latest consumer price inflation numbers that will be released by StatsSA later today.